Alright, so continuing on with the weighted average cost of capital. So I wrote down the whole formula here for you. I broke down this formula in the video before, so if you didn't watch it, make sure you do. And I also added this this preferred shares portion here, so this P over V times RP. And so now what we're going to do is we're going to go through each part of this formula and break it down into a little more detail. So it should help you see it clearly. Now, there can be different cases for these types of questions, so my best advice is to take this format that I'm giving you as just kind of like a general overview, but make sure you do as many questions as possible, because honestly the cases that these guys can throw at you for these types of questions are infinite. So the more practice you get, the more comfortable you'll get, the more you'll be able to recognize certain cases and then what to do. But let's do this general overview. So the first thing that we're going to go into detail about is this D portion, which is the market value of debt. I mentioned that in the previous video. And the market value of debt is it's pretty easy. It's the number of bonds that a company has times the market price per bond. All right. So the number of bonds part, this is usually given. And the market price per bond, that's sometimes given and sometimes not, right? So if it's not given, if it is given, it's easy. All we do is we take the market price of each bond, not the book value. Remember, this is the market value of each bond times it by the number of bonds, and we have our market value of debt, and we're done. We already know what the D portion is. However, if this market price per bond is not given, they'll probably give you the characteristics of the bonds they issued. They'll give you the coupon rate, what the yield to maturity is, what the maturity length is, and we'll be able to calculate the price per bond. And this is a review of the bond chapter. So all you would do here is in your calculator you would be solving for PV. This is what you're solving for, the price per bond. The future value usually is going to be 1,000. Sometimes a question will say that each bond has a par value of 100, then this would be 100, but usually it's 1,000. And then your N would be the number of coupon payments remaining. All right, it's the number of coupon payments remaining. So if you have a bond that's paying semi-annual coupons and they have 20 years left to maturity, well, they're paying a coupon twice per year. There's 20 years left. That means the N would be 40. So it's the number of coupon payments remaining. Your IY would be the yield to maturity. This would also be given, so this would be like your market rate. All right, and then the final thing is your PMT, which is your coupon payment. And you get that by taking the coupon rate and multiplying it by the face value, which is usually 1,000. All right, so the coupon payment is equal to the coupon rate times the face value, which is usually 1,000. So, and that's it. That's it for calculating this portion, this D portion. So sometimes the price per bond will be given. If it's not given, you'll have to calculate the price per each bond, and you'll have to use the characteristics that they give you of the bonds that they issued. Okay, so moving on with the weighted average cost of capital, now we're going to deal with the E portion of the formula, which is the market value of equity. Remember, it's the market value, not the book value. So sometimes a question will just give you the market value equity, which is easy. Then we have our E and we could just move on. And sometimes they won't. So the way that you calculate the market value of equity is the number of common shares times the market price of each stock. Right? Makes sense, right? The number of shares that they have issued times the market price of each stock or share. And that will give you the market value of the equity. Now, usually, this is usually given. All right? And the market price of each share is sometimes given, which would make it easy. All we have to do is take the number of common shares and times it by that stock price and we get the market value of equity. Sometimes it's not given. So if it's not given, this is a review of the stock chapter. We'll have to calculate the price, and usually what will happen is that the question will give you the characteristics of the stock, like what kind of dividends they're paying, and are the dividends growing, at what growth rate, etc., etc., etc. So all we do here is we just use the dividend discount model, which is the dividend in 1 year over the return on equity or the return on the stock minus the growth rate. So this is a review from the stock chapter. When we do a weighted average cost of capital example, we'll go into more detail on how to do this. But if you really want to go into detail, the best thing to do is to go back to the stock chapter and just do a couple of these questions. Now, usually with weighted average cost of capital, in this chapter, the calculations to calculate to find the stock price won't be as complex as the stock chapter, but still, I would recommend going over some questions from that previous chapter just to get used to this, because you're definitely going to have to be using the dividend discount model. So just to recap, if the E is equal to the market value of the equity, sometimes it's given, easy, just move on. Sometimes it's not given. We take the number of common shares, multiply it by the market price of each share. Sometimes the market price of each share is given. If it's not given, we have to use the dividend discount model to find each price, and then we can find the market value of the equity. All right, moving on with the weighted average cost of capital breakdown. So now we're going to go into detail about this portion here, this P. And the P is the market value of preferred equity, and preferred equity is the easiest to deal with out of the debt, equity, and preferred. Again, sometimes the question will give you the market value of the preferred equity, which is easy. It's just the P. If not, then how you calculate it is the number of preferred shares times the market value per preferred share. And finding the market value per preferred shares is pretty easy. It's sometimes it'll be given, usually not though. So if it's not given, basically the price is equal to whatever the dividend is. Usually the dividend will be constant and won't be growing, over RP, which is your return on preferred. All right, so it's just a perpetuity, a non-growing perpetuity. So it's just the dividend that the preferred stock is paying over the return on preferred, and that's your price. Plug it into this portion. So the number of preferred shares times your price gives you the market value of preferred equity. Usually the preferred dividend is given to you. Sometimes it's not. Sometimes they'll tell you that the dividend is like a percentage of the face value, and the face value will be like 100 usually. So if they say the dividend being paid is 6% of a face value of 100, then this dividend would just be $6. So you may have to do do a separate calculation to find the dividend. It'll be really easy. Usually though, the dividends are given, and you just divide them by the return on preferred to get the price. All right, moving on with the weighted average cost of capital formula. So now we're going to move on to the V part of the formula, and the V is in all three pieces of the WACC formula. And the V is super easy. It's pretty much whatever values you got from step 1, 2, and 3, just add it together. It's your debt, the market value debt plus the market value equity plus the market value of preferred. So the market value debt we found in step 1, market value equity found in step 2, market value of preferred equity we found in step 3, and this V is just equal to the value of your company. So that's step 4. All right, so continuing on with step 5 of the weighted average cost of capital, we're going to go into detail about this RD here. And the RD is just basically equal to the return or the cost. Sometimes the questions have cost of debt. And that's just equal to your yield to maturity of the bonds you issued. It's also like your market rate. So it could be called a bunch of different things, and sometimes it's given and sometimes it's not, right? So if it is given, it's easy. We just plug it into the formula here. However, if it's not given, we're going to have to calculate it using the characteristics of bonds. Usually the question will give you the characteristics of the bonds that the company issued. So the coupon, the maturity, the price, etc. So what we're going to be finding is the IY, right? That's going to be your RD. That's the yield to maturity. Now remember, this has to be in annual terms. So if you're doing it where the coupons are semi-annual and you calculate the IY, you're going to have to multiply it by 2. Just remember that this RD here, it's in annual terms. So you might want to write that down. Annual term. Okay, so your IY is what we're going to calculate. That's going to be the yield to maturity, or your RD. The PV will be the market price of the bond. All right, your N will be the number of coupon payments remaining. Your payment will be the coupon payment, which is just the coupon rate times the face value, and then the face value will just equal usually 1,000 per bond. Sometimes they might give you a different face value, but usually it's 1,000. So you plug all these into your calculator. Now remember, watch your cash flows here. So the present value, the price of the bond, we buy the bond, so we're spending money. That will be a negative cash flow. And then you're receiving the coupon and you're receiving the face value at the end. So these will be positive in your calculator. So inputting all of this information, we get our IY. Remember, if we're dealing with semi-annual coupons, then we'll have to multiply this, this by 2, and that will be our RD that we plug into the formula. All right, moving on to the sixth step of the weighted average cost of capital formula. We're going to calculate this RE now, which is the return or the cost of equity. And sometimes it's given, sometimes it's not, and if it's not given, there are 2 ways to calculate this one. It could be either way. The first way is using the CAPM formula. All right, so you may want to review the capital asset pricing model. Don't go too crazy in reviewing it. It's just basically a formula. So your RE is equal to the risk-free rate plus the beta of the stock, the return on the market, minus the risk-free rate. All right, so if you see a question where they're giving you, where you see a beta in the question, then you know usually you're gonna have to find the cost of equity or the return on equity using the CAPM formula, which is this. The risk-free rate plus the beta times the return on the market minus the risk-free rate. Another thing you want to be careful with is sometimes they'll give you this this market rate, or sorry, this is return on market. But other times they'll give you something called a market premium. And the market premium is, if you recall from Finance 1, it's just this whole bracket. All right, so be careful. If they give you the return on the market, then you plug it in for RM and you do this whole bracket yourself. You minus the risk-free rate and then calculate the return on equity. If they give you the market premium, you look for this word premium. That's that whole bracket. And then you just take that, whatever that number is, and you just multiply it by the beta, add it to the risk-free rate to get your return on equity. Now, the other way to calculate the return on equity is from the dividend discount model. So dividend discount model, this is review from the stock chapter. So if you recall the dividend discount model, you calculate the price of the stock by taking the dividend, right, over the return on equity, which is RE, minus G. That's the formula. That's the general formula for calculating a growing dividend price of a stock. So what we're calculating is this RE. So if you were to manipulate this algebraically, RE would equal to the dividend that you're paying in 1 year over the price of the stock, the market price, plus G. Right? So this is the formula for RE if you're going to calculate it using this way. So the way that you can tell which way you're going to use to calculate RE is basically by what the question gives you. If you see the question giving you the price of the stock and they're giving you the dividends, then you know that usually you're going to have to calculate it using the dividend discount model. If you see a beta in the question, then you know you're going to have to use the CAPM. Now, one more remark I want to make about the dividend discount model. Remember that this D1 here, that's the dividend in 1 year. So if they give you the dividend that the stock just paid, remember you have to grow it till 1 year. So D1 is equal to the dividend now, 1 plus G. You have to find out what the dividend in 1 year will be, and then you plug it into this formula. So sometimes they'll give you the dividend in 1 year, sometimes they'll give you the dividend that it just paid. If it just paid it, then you have to find D1, then plug it in the formula, and you get your RE. Alright, so continuing on to the next step for the weighted average cost of capital, the WACC formula, and it's the final step actually, and that's calculating this RP here, this return or cost of preferred equity. And this one is super easy. Sometimes they'll give you the return on preferred equity. If not given, then remember that the price of a preferred equity stock is just equal to the dividends that the preferred is paying. Usually they'll be constant dividends, they won't be growing, over RP, which is your return on preferred, which is what you're finding. So if we rearrange this, basically the return on preferred is equal to whatever the dividend is that the preferred stock is paying over the price of the preferred stock. And that's the formula. That's it. That's all you have to do to calculate RP. Usually there's no other tricks. So preferred equity is the easiest to deal with. And that's the final step. That's the final step for calculating all this. The one thing that I didn't go over, I guess, is this T, and that's just equal to your tax rate, right? Or your corporate tax rate. Right, because the return that you're paying the bondholders, that's if you're a company and you're paying return to your bondholders, that's tax deductible. So we take it on an after-tax basis. So T is just your tax rate, and yeah, that's it. So 7 steps. When you're doing these questions, make sure you write down each step. Number 1, market value debt. Number 2, market value equity, etc., and break each one down. And then plug it into the formula and you'll get your weighted average cost of capital. The final remark that I want to make is make sure that when you're calculating this RD, RE, RP, when you're plugging into the formula, that they're all either in percentages or they're all in decimals. Make sure they're all congruent, because if they're not, then you'll get a screwed up weighted average cost of capital. But yeah, other than that, follow those steps and you should be fine. Obviously, sometimes you'll run into tricks. Sometimes you'll have questions where they'll have like multiple debt issuance. But overall, in general, these are the steps that you follow to solve these kind of questions.